What's going on, everyone? My name is Nicholas Burton here at DataDash, and today is October 8th of 2017. Well, folks, as you keep up with the channel, you know that from time to time I like to share a trading tip here on the DataDash channel to help you all better your trading and investing journeys through cryptocurrencies. And today I want to answer a question that I got a lot from my last video. In the last trading tip video, I talked about 3 signs to buy, 3 signs to get into a cryptocurrency to know when a good buy is in and it's time to make some gains. However, the other important question is when to lock in those gains. Let's say, for example, you followed those trading tips, or maybe you did it your own way and you're in the money. That means you're doing well in your cryptocurrency position, or maybe, on the topic of stocks, you bought Apple stock or something and you're up 20%. Well, that's great, but the question is, when is it time to sell? Well, in the cryptocurrency market, this is a very important question because a lot of people can get carried away with double-digit or triple-digit gains in a short period of time. And they can think that the fun money is going to last forever. Well, in cryptocurrencies, that's not how you want to think. And really, you want to apply some kind of technical strategy to really make sure you lock in profits and stay disciplined. So, what are those 3 signs today? I'm going to go ahead and tell you all today 3 common signs I use to know when to lock in profits and sell on positions. All right, so let's go ahead and dive into it. First one I want to talk about today is the 9-day moving average. Now, I know you're thinking like, Nick, don't you always talk about the 50-day, the 100-day, and the 200-day, and you say to rarely use the 21-day unless something's a momentum mover? Yes, this is true. However, I use the 9-day moving average not as a level of indicating support, but for fast runners. A lot of us are investing in things. For example, I could go back through a lot of the momentum movers, Stratis, Omisego, which we're looking at now, ARK. I could list a dozen examples of examples where this type of strategy will work. The 9-day moving average is a great indicator to lock partial share positions on good runners. So, for example, in the case of Omisego, this was a very fast mover. There was a lot of anticipation coming into it. Now, this isn't always going to apply, but it applies to around 60 to 80% of the fast movers in cryptocurrencies. As we can see, not only does it usually maintain above the 9-day moving average, but if it goes below the 9-day moving average, it's only slightly through the wixes. And a way that I use the 9-day moving average to lock in positions, and we have to think about it in a perspective of buying down in this range, for example, getting in early on. In this case, a good way to use the 9-day moving average is whenever it dips below 5% of the 9-day moving average. So, for example, we take a partial share here, we take a partial share here, and once it gets back, of course, we want to wait till it gets back up above as well. Now, you can set stop levels. That is something completely kind of arbitrary to what your risk and reward profile is. It doesn't have much to do with this, though. The main thing to keep in mind is that every time you break that 9-day moving average, okay, you sell a partial share. You lock in some profits, okay? When you get back up there, that rule will come back to apply again. If it comes back down again, you take another partial share. But in most cases, once it gets back up against that 9 days, we've seen each time it rallies to new highs. And then eventually you have a decent breakdown away from it, and then you lock in probably your final partial share. Now, of course, the way to do this is really dependent on how you want to trade it. Some people want to take 50% that initial time and be like, hey man, look, I'm up like 300 or 400% on something. I'm going to lock in half of my money. Some people might say, look, this is going to go up 1,000% and I'm going to lock in 25%. Really, it's all subjective to how you want to do it and how much your risk to reward profile is. My initial sell usually consists of around 40 to 50% of my profits locked in right off the bat. And then I break down each and every other kind of partial share as I go up the uptrend. And of course, I raise my stop level as well to cash out all of it, just in case if this thing starts really pulling back, to lock in my profits. Because again, you don't want to just be like, getting, all the way up here and then it just crashes down 50%. You're like, no, it's going to go back up, and then it goes down below where you bought it. No one wants to get caught in that, but so many people do. So again, adjusting your stops, but really the main strategy here is taking partial shares once a cryptocurrency goes below the 9-day. In stocks, this doesn't apply as much because stocks are much tended to not move up this quick. This is definitely something for cryptocurrencies, okay? So for stocks, it'd probably be something like the 50-day because they're not going to move up as fast as a cryptocurrency in most cases. The next thing I want to talk about is a topping pattern. Now, what is a topping pattern? Well, we've got one right here in the Omisego chart. tell me what candle on this chart, I want to get you thinking real quick because I don't want to just tell you things. I want to ask you all, what candle on this chart looks like a topping pattern? I'll give you a second. Well, I don't know what candle you picked because I can't hear your voice through the screen. However, I will assume that you guessed this candle. And if you did, you are absolutely correct. This is what's known as a topping pattern. Now, everyone will toss different names at it, but this is generally what is known as a topping pattern in technical analysis. Now, you can probably guess why it's called a topping pattern if you know how to read a candle chart. And if you don't, I recommend you start using candle charts, folks. I know a lot of people want to use line or area charts. Candle charts are the way to go. In this case, with a topping pattern, you can see that the wicks of the candle is well over 2 to 3 times the actual gain of the day. And what that means is that a lot of this gained price action closed downward. It was complete FOMO. That means that buyers were coming in too quick, and then they realized that it wasn't fundamentally sound in the sense of that price action, so it pulled back. And because of that, that speaks of overexuberance. It speaks that there wasn't either enough volume, there wasn't enough reason for it to move up, and because of that, it can make the chart look very ugly. I know that sounds silly, but because of that, it can lead to a lot of sell side, and it can really send signals to the market that something is overbought, that something is being a little too overexuberant. And as we all know, as I repeat 1,000 times, overexuberance can make up all the difference in just a few days or weeks, and we're seeing that right now with Omise Go. So again, when you see a candle like this, especially for those low volume cryptocurrencies that, as much as I tell y'all not to trade, I know some of you want to go out there and trade, do not chase cryptocurrencies that have these really long drawn out wicks. You want to see candles like this that have full green bars that continue to go up and confirm price strength confirmation. You do not want to buy into something like this. So again, you really want to make sure that the candles have solidified price action. A lot of good healthy green candles, and of course they have healthy corrections as well. Not these topping out wicks where the wicks itself makes up more than 2 to 3 times the standard price action of the day. All right, so the last thing I want to talk to you all about, and of course this doesn't always apply to all cryptocurrencies, it's just a simple signal that you can look for in the sense of technical patterns. It's a head and shoulders pattern. Now we've talked about this on my channel before. However, today I want to go ahead and talk about it specifically inside Omise Go. Again, all 3 signals that I want to talk about today were found in Omise Go. And it's quite simple. So we're going to go ahead and use the drawing tool. I recommend using a line tool, but in the case of TradingView, it's very drawn out. But here we go in the sense of drawing it. Simply, we just have to draw the first shoulder, the head, and then the other shoulder, okay? So this is a very common drawn pattern in cryptocurrencies and stocks, any financial investment vehicle. You'll find head and shoulders a lot. Now, a lot of people will call it Elliott waves. A lot of people will call it... I've been hearing so much about Elliott waves. I don't get what the craze is about that. But anyways, in the case of head and shoulders, it's a very common pattern, and it really looks like head and shoulders. It's really much like, you know, going up your shoulder, going up your head, bouncing down again, and then going down to new lows. And as you can see, the selling is starting to pick up on Omise Go because people are realizing this is a head and shoulders. And you'll find this a lot in other cryptocurrencies that are topping out or have had ridiculous run-ups. Like Omise Go, it's gone up more than 10%. It needed a correction, okay? So you'll find this a lot when there's so much strength behind something, but after a while, the steam runs out. The volume stops flowing in. The price is too overbought. So again, look for these kind of head and shoulders patterns. And ironically, you'll find this a lot in these topping patterns. You'll find it when it starts to roll over and it has that almost kind of dead cat bounce. And it's like, oh, we're going to get back to those highs. Don't worry about it. And then you get caught in the bear trap and you get pulled down. And of course, you start losing your profits. So these are 3 great signs you can use to start, you know, timing the market a little bit better, locking out of your profits, knowing when to get out. A little bonus tip as well, and I've mentioned this in the past, I feel like it'd be important to mention it. Notice where Omise Go stopped really getting bought at. Now, of course, we had the wicks go up here, but sometimes you have to look for the big evens. 300,000 was the resistance point. Really, I think that was the big even. As you can see, the candles over here couldn't get past it, and when it tried to get past there, it couldn't remain over 300,000. The fourth tip I'll give you on this, kind of a mini tip, is look for the big evens. You all know I talk about this a lot, but I thought I'd toss it in there because that's a great way to know when to sell something, okay? Because the whales are going to sell at the big evens, 300,000. In the case earlier, I know that, for example, 200,000 was a huge resistance point. There's a lot of sell side action at these levels, and because of that, you want to lock in your profits a little bit beforehand. So it might have been smart to lock in some profits here before 300,000 on these days. Again, be ahead of the game, use strategy, use these technical analysis skills, tools, and patterns to stay ahead of the game against the competition, and I can promise you, you'll have a much higher chance of coming out on top. Well, folks, that's it for the video. Thank you all so much for watching. I hope you enjoyed these tools and all the things that I shared in the video. If you do enjoy the video, please drop a like and leave a comment down below if you want to see another trading tip video and a certain topic covered on the trading tip series. I always love getting your feedback. But until then, everyone, I will see you all in the next video. Stay tuned.